Investing terminology feels like a foreign language, but in the next 8 minutes, I'm gonna make them brain dead simple for you guys. I'll ensure that you don't end up lost in a sea of financial jargon, drowning in confusion while your money sits idle, getting corroded by inflation. In a world where your savings can vanish faster than a magician's rabbit, knowing the lingo can be your lifeline. So sit back, relax, and let me get you guys on track. Imagine stocks as your golden ticket to the wild amusement park that is the corporate world. When you buy a stock, you're essentially snagging a piece of ownership in a company, like holding a lottery ticket that could either make you a millionaire or leave you crying into your cereal bowl. It's a thrilling ride where the highs can feel like soaring on a roller coaster and the lows can drop you faster than a lead balloon. Think of it this way. Investing in stocks is like betting on your favorite horse at a racetrack. You might pick the thoroughbreed that's been winning all season, or you could end up with a nag that stumbles out of the gate and gets handicap parking. The thrill of winning big is intoxicating, but the risk of losing it all is always lurking in the shadows, ready to pounce. So buckle up and hold on tight. In the world of stocks, every investment is a gamble, so you never know when you might hit the jackpot or faceplant into the dirt. At the end of this video, I'll explain diversification, which can turn an amputated limb into just a scratch. On the flip side, we have bonds, where excitement takes a backseat and the pace is as slow as your sleepy, possibly stoned cousin at a family reunion. When you buy a bond, you're essentially lending your money to a company or government, like giving your cash to that relative who promises to pay you back after their nap. Sure, it's a safer bet than stocks, but let's be honest, it's about as thrilling as watching paint dry. Bonds are the reliable, lower risk option for those who prefer to keep their heart rate steady. While stocks can send you on a roller coaster of emotions, bonds are more like a gentle stroll through the park. No sudden drops, just a nice, predictable path. But remember, with lower risk comes lower returns, sometimes not even covering inflation. So if you're the faint-hearted type who breaks into a sweat at the thought of market volatility, bonds might just be your cozy weighted blanket. Just don't expect to get rich quick, or at all possibly. After all, this isn't a high-stakes poker game. It's more like a game of checkers with your grandma. If you use bonds as a safety net, just never invest in just one, because if that company files for bankruptcy, then you're cooked and they no longer have to pay you back. Mutual funds are the group therapy session for investors who want to pool their money together and share their financial woes. Picture this, a bunch of investors sitting in a circle, each tossing their cash in like it's a potluck dinner. Instead of bringing potato salad, they're contributing to a diverse mix of stocks, bonds, and other assets, creating a delightful buffet of investments. The beauty of mutual funds lies in their diversification. One minute you might be investing in tech stocks that are soaring to the moon, and then next you're supporting a sleepy utility company that's about as exciting as watching grass grow. It's like a financial support group where everyone shares the risks and rewards, because let's face it, no one wants to go it alone when the market gets rocky. The downside is the parent company like Fidelity or Vanguard takes a cut of your earnings for managing the potluck dinner. So, if you're looking for a way to dip your toes into investing without feeling like high diving off a cliff, mutual funds are your safety net. Just remember, in this group therapy session, everyone's in it together. Now, in the wild animal kingdom of investing, we have two dominant species, the bull and the bear. In a bull market, prices are rising faster than a bull charging through a china shop. Investors are feeling as optimistic as a kid in a candy store. Everyone's making money, and it's a party where the confetti is made of dollar bills. Why is it called this? Well, if you've ever seen those gruesome Instagram reels, you'll know that a bull thrusts its horn upwards, throwing the unsuspecting Mexican playing poker, or in this case your stocks, sky high. On the flip side, we have the bear market, where prices are falling like a bear that just woke up from a long hibernation. grumpy and ready to swipe downward at anything in its path. In these times, investors are more anxious than a deer caught in headlights, watching their portfolios shrink faster than a snowman in July. Meanwhile, experienced investors pick up as many discounted stocks as they can. Beware, when the market crashes, it's like a literal bull run, leaving chaos in its wake. All you need to know is an average bear market is only 9 months compared to a bull run's 4 years. So if you hold your investments and double down, you will see huge gains over the long term. So let's talk diversification, or as I like to call it, the golden rule of not putting all your eggs in one basket. Imagine you're carrying a basket filled to the brim with eggs, each one representing your hard-earned investments. Now, picture yourself tripping over a rock and watching that basket tumble to the ground. Crack! You've just turned your financial future into a scrambled mess. Ignoring diversification is like inviting disaster to your investment party. If you only invest in one stock, you're basically betting your entire fortune on a single egg. And we all know what happens when you put all your faith in one fragile egg. It's bound to crack, and the worst possible moment, leaving you with nothing but a sticky situation. By spreading your investments across different assets, you're not just playing it safe, you're creating a delightful omelet of opportunities. So remember folks, diversify like your financial future depends on it, because it does. After all, nobody wants to be the person who ends up with a basket full of broken dreams. Risk tolerance is essentially your ability to handle a financial pain without breaking down into a sobbing mess. Think of it as your personal threshold for discomfort, like how much spicy food you can handle before reaching for the milk. Some investors are thrill seekers, diving headfirst into high-risk stocks like they're bungee jumping off a cliff, while others are more like cautious cats, tiptoeing around investments like they're stepping on hot coals. If you're the type who panics at the first sign of a market dip, you might want to stick to safer investments like bonds or good old high-interest savings accounts. But if you're ready to embrace the roller coaster of the stock market long term, then go ahead and strap in. The key is to assess your own risk tolerance honestly. Are you a daredevil or a delicate flower? Knowing where you stand can save you from sleepless nights and unnecessary heartache. So grab a mirror and ask yourself, how much financial pain can you really handle? We've tackled stocks, those thrilling lottery tickets to the rich, bonds, the sleepy cousins that promise safety, mutual funds, the group therapy for investors, and the animal kingdom of bull and bear markets. Understanding these terms can mean the difference between thriving and merely surviving in the investment jungle. If you appreciate me doing this for completely free, harass that subscribe button, and let's build wealth together.